My name is Mary Castillo and I'm a financial credit counselor and I help people with money management. Today we're going to talk about credit reporting and what affects a credit score. So Jerwin has some questions for me and then I will start to explain some of the different things in regards to credit in Canada.
Oh yeah. Actually, our topic is like a credit reporting in Canada. So question I can ask is, number one question is, how is credit? Hello, good morning mga kamamo. I'm here with Mary Castillo and maybe she will explain you something very important here. That's why we're here now in your house.
Hi there, my name is Mary Castillo and I'm a financial credit counselor and I help people with money management. Today we're going to talk about credit reporting and what affects a credit score. So Jerwin has some questions for me and then I will start to explain some of the different things in regards to credit in Canada.
Oh yeah. Actually, our topic is like a credit reporting in Canada. So question I can ask is, number one question is, how is credit reported in Canada?
Yeah, so in Canada, there's two main credit reporting agencies. There's one called Equifax and the other one is called TransUnion. And those are the only two credit reporting agencies in Canada. So if somebody was to look up their credit score, they would go to those credit reporting agencies.
Oh, I see. So my second question is, what makes up a credit score?
Yeah, so there's many things that affect a credit score. And actually I have a little diagram behind me here. And if you can't see it, I'm going to explain it to you. So one big portion of that credit score is your payment history. And that makes up 35% of your credit score. So that means when you make payments, you want to make sure you're making payments on time before the bill is due, making sure that you're paying it on time regularly. And that has a big factor in your credit score. The next big portion of that credit report is credit utilization. And so credit utilization makes up 30% of your credit report. Now what credit utilization is, I'll try to explain it a little bit easier, is if I had $1,000 available limit on a credit card and I was to use that credit card and pay it off, I want to keep that utilization ideally below 30%. So if I had $1,000 available on my credit card, I want to use it up to $300 and try to pay it off. If I go to the max, if I max out my credit card to $1,000 and I'm only keeping up with minimum payments, then my credit score will actually start to go down. So what we want to do, it's okay to use it up to the max, but we want to try to pay it off as much as we can. And we want to keep that utilization below that, ideally 30%. It's okay to keep it below 60%. Of whatever you're using it to keep that ultimate credit score. Okay. The next part of that is the length of your credit history. Okay. So the longer you've been using credit here in Canada, it starts to build a history there. And that makes up to 15% of the credit score. So I'm going to give you an example here is if I had a credit card and I missed a payment and I've had credit for 20 years here in Canada and I missed a payment, my credit will be affected. But it won't be affected as big of an effect as if I was brand new to Canada and I've only had credit for a year and I missed a payment. It's going to be a harder hit on my credit score. So that history does play a role. The longer you've had credit and used it successfully, that really supports your credit score overall. And then we have types of credit. That makes 10% of your credit score. So when we look at types of credit, there are many different types of loans, credit cards, lines of credit, different things that we can get here in Canada. And what we want to do is we want to use credit that we might get from a bank because usually it has a lower interest rate to it. There are places here that have something called payday loans or high interest type of loans. If we're using those high interest loans, those actually start to bring our credit score down. So the types of credit that we use actually have impact on our credit score as well. And then the last little bit is hard hits, and that makes 10% of our credit score. So a hard hit is if we're applying to get access to a credit card or a loan. And so if I went to, in Canada, there's many places that offer credit cards. If I went to a store and applied for a credit card, and I went to the bank and applied for a credit card, and I went to another place and applied for a credit card, every time I apply to get access to this credit card or a loan, it's a hard hit on my credit score. And what will happen is if I have a lot of hard hits, especially in a short amount of time, it'll start to bring my credit score down, okay? Something else to just note is like if you are checking your own credit report, it's a soft credit check. So a soft credit check is just if we're looking at our credit report for information and we're not actually applying to get access to a loan, then that will not affect our credit score. So if we wanted to check our own credit score here in Canada, we could check our own credit report 1,000 times a day and it will never ever affect our credit score. Or if you are going through an insurance company and they do a credit check, that's okay. But what hard hits are is when we're actually applying to get a loan, then that's when it starts to affect the credit score. So there's many things that kind of come into play to affect that score. Yeah.
Okay, our third question. What is good credit score and what is poor credit score?
Oh, actually, I do have another visual for that.
Yeah, sure.
I should have pulled that up. So I just kind of pasted that. So there's different credit score ranges that affect your credit score. So a poor credit score is below 559 and under, and an excellent credit score is 760 or over. Okay. Now, just so you are aware, the two credit reporting agencies in Canada, they actually report a little bit differently from each other. So if I have a great credit score on Equifax and my TransUnion one is maybe good, they just do a few little reporting things different, but it's nothing to be alarmed about.
But actually, usually I used to call the second one you told me. No one's picking up. That's why until now, honestly, until now, when I check my credit score on my bank, it's like an error or something until now.
Okay.
So the bank, my RBC bank, like they gave me the number of the one you told me,
Equifax,
but yeah, no
TransUnion.
one's responding. So until now, I don't have. It's still error on
your credit score. So sometimes if you have issues getting a copy of your credit report, they might not have the updated information on, for example, where you live. They might have ask you questions that maybe it's not updated on the credit report. So that could be a reason behind that. There are different ways you can check your credit report. You can do it online. There's a telephone number that is like an automatic you have to push buttons. There's no actual person that you talk to.
Like an operator, they ask you what's your first one? Then after that, they will bring you to the teller or something like that.
Yeah, so sometimes it can be a little bit of a tricky thing to get your credit report, but I'd always encourage always just to keep trying and try different
Maybe I
ways
should
to
try
go
the
around that.
Equifax. That is the second one. The first one. I'll try to call.
Yeah, try to give them a phone call. But also just so you know, some companies report to Equifax and some report to TransUnion. So if you are monitoring your credit and checking that, it's always a good idea to check both credit reports.
I see. So it doesn't affect your credit score or something if you ask them like both. Usually, I'm not too 100% know everything about this one because some other people told me like, oh, if you check from Equifax or check from the other ones, like, or maybe your credit score will get a little lower because you ask often. Is that true?
So that's a great question.
Yeah.
So again, that goes back to the hard hits and soft hits. So only if you do a hard hit. So if you check your credit report, it's a soft credit check. So it will never ever affect your credit score.
Okay.
So a soft check is just looking, that's how I keep it straight in my mind, is a soft credit check. You're only looking at your credit report for information. You just want to see what your credit score is.
But you don't do anything.
Don't do anything with it. Then that never affects your credit score. So you can check your score 20 times in a day. It will never ever affect your credit score. But if you go to a place and you're applying to get a vehicle loan or you're applying to get a mortgage or trying to get something else, then that can start to have impact. That's a hard hit.
I see.
Hard hit on the credit report.
I see. Makes sense now, so I have an idea now.
Yeah. And that's also like a lot of people get confused by that because there's not very clear information out there always. So it's great that you're doing that.
It's a good
find this information
but
out.
also it's a good information that Mary gave us. Usually Filipinos, because some of the Filipinos doesn't know, oh, I'm gonna get a hard hit because I always check my credit credit score even if I don't use it from anything, you know. But now Mary explained it that you can take a look like 20 times in a week. It doesn't matter as long as you never just to show or just to see your credit score, which is good. So you don't need to think like, oh, I'm gonna get a less credit score because I keep checking my credit score. Yeah.
Yeah, so it's good.
Yeah.
And then if we look at, you know, the good credit score, excellent credit score, all of the things that we just talked about, what makes up that whole credit report can help you to build your credit score with that.
So it's nice. So it's like very good. So usually it's hard to get the excellent one, right?
Yeah, so I will always say you can never ever have a perfect credit score. It's always adjusting, it's always changing. We always want to work towards the good or very good. Excellent is very hard to get, okay? So,
but based on your experience, what usually what usually on this chart gonna be like the usual thing they can get for a higher rate, a higher
you can be in the good or very good range is like what the banks are looking for, what they're looking for to get approval on credit. And excellent is fantastic, but most people kind of fall in this range of good and very good, unless they're having some issues with paying their loans, falling behind, or they're maxed out for a very long time on their loans, then it can start to creep back down.
Why people get the poor?
So that poor credit score is, for example, like, so many people, every one of us can experience financial hardship. So nobody is immune to this. Life happens, okay? Why somebody would have a poor credit score is if they have debts that have gone to collections, or if they've gone through bankruptcy or consumer proposal, if they've gone through something where they cannot keep up with those payments, then that can affect the credit score.
Or misleading, like a misleading using your credit card, you know, or something like.
Misusing that. So if you are, if you use it and it's kind of maxed out for a long period of time, but you're making minimum payments, that will start to pull the credit score down, but it won't put you in the poor spot exactly. Usually that's when when you're starting now to miss payments, or you're over the limit of what you have on a credit card. So maybe your credit card has a $1,000 available limit, but you owe $1,200, and you can't get it back down to a reasonable level, that credit utilization.
So makes sense now. I really, actually, while we're talking about this one, like, I've learned a lot from Mary now. So, are we gonna go to the next question?
Yeah, sure.
Okay, I think this is my last question for the credit reporting in Canada. How can I start building credit in Canada?
Yeah, so one of the easiest ways you can start building your credit is actually having a cell phone plan. A cell phone plan does report to your credit report, and you want to make sure when you have your cell phone bill, you pay it off in full every month. If you do a partial payment for your cell phone, then actually it will show almost like a missed payment. So a cell phone has a type of plan where you have to pay it off in full. And if you are also starting off in Canada, a lot of companies do offer newcomers credit, and they do offer newcomers different types of ways to build. So a credit card can be a great way to build your credit. But I want to warn you, if you are using a credit card, you want to be really careful with that, because it's very easy to spend money on a credit card and not have ability to pay it off in full regularly. So if we do have a credit card, we want to use that from time to time and make sure we pay it in full on time, and make sure it's being dealt with. If you do not qualify for a credit card, you can get something called a cash secured credit card. And a cash secured credit card is
I haven't heard that.
You haven't heard that one, right?
Because usually when you get here in Canada, basically you'll get credit card right away because not in the Philippines like it's hard for you to get a credit card.
Yeah.
Not like in here. That's why when I talk about like something on my videos before, like it's easy to get credit card here in Canada other than Philippines.
Yeah, it can be very easy.
Yeah.
There are some cases though where somebody cannot or they have issues getting a credit card.
Yeah.
So a secured credit card, companies do that where you have to, you save up some money, you give it to the company as a deposit.
Oh yeah.
They hold that money as collateral. Like, so for example, $500, they keep that in an account with them, and then they'll give you a credit card to use with a $500 available limit. When you use the card, you pay it back monthly and you use it and pay it back. Over time, it builds your credit and they're going to give you your savings back.
So that's the...
So it helps you to establish that credit.
Okay.
But if you can get a credit card right away without that deposit, it works exactly the same way, but then you want to try to keep it paid off or keep your balances low on that.
Oh, yeah.
So an easy way to do this, if we just want to be very careful about building our credit, is we might use that credit card to buy a pack of gum.
Yeah.
We buy a pack of gum, it's only $2.
Yeah.
But it's showing that there's a purchase made. And then what we do is we want to pay it off before the bill is due. So it will have a bill date and you want to pay it off within 25 days.
Oh,
this
25,
is this is the interest-free timeline.
Oh, interest.
So you want to pay it off at the bill date, and that will make sure that you don't pay any interest on that credit card, but it will show that you used it and that you've paid it off.
That's the first time I've heard that because all I know is after a month. Good thing you told me 25.
Yeah.
So I'm gonna write it down on my notes. So I need to pay before 25th day.
Yeah.
Okay.
25 days. Because if you pay it after that timeline, then they're going to charge you interest on that $2. And so you might have to pay, I'm just going to go round numbers, like you might have to pay $2.30 instead of $2 back because there's interest that's added.
Oh, yeah. So I have lots of, I've learned a lot from this interview. So it does, just want to show you that I want to share the videos here. At the same time, I'm learning a lot from this lady. Yeah. So
and
it's not easy, right?
No, and this is a lot of information, and I will say even Canadians that have grown up here in Canada don't always have this information. So it's really important that you have this knowledge before, even starting with using credit. But even if you've been here for a long period of time here in Canada, this information is stuff that even, myself, I didn't know as a child growing up. It took me a long time before I learned it myself. I went to college and had worked in the financial industry. I've been in the financial industry for many years to learn this information.
Nice. It's like a very informative type of video. That's why I've learned a lot, and then I'm really thankful that Mary gave me a chance to share this information to everyone. So I know every people who's watching this video now, they will know, or maybe they will shock that they never been know about all the information here, and then oh my God, I need to do this one right away when I watch this video.
Yeah, and it's good. It's good to have that if you can get started with it. But even if we've been using credit for a long time, it's good to have this knowledge to make some changes if needed. Have that experience.
Okay, number 2 topic, we're going on the lending guidelines, what banks look at when giving a loan. So ayan, sa mga, sorry, I'm just gonna speak Tagalog. Sa mga gustong maglo-loan, paano bang mga diskarte, they will explain everything about this one. So maybe I'm gonna put my question here now. So why would a bank decline me for getting a loan if I have a good credit score?
Yeah, so that's a great question. There's actually, a credit score is one small piece of what happens when a lender's looking at giving a person a loan, okay? And there's something called the 5 C's of credit. So I'm going to say the words of what they are.
5C?
5C,
5C, okay, 5C.
So the first one is character. Second one is capacity. Third one is capital. Fourth one is collateral, and the last one is conditions. So I'm going to explain each of these to you. So the character is your credit score. So they'll look at your credit score, see, have you been paying your credit card on time? Do you pay your cell phone regularly? You know, have you been using credit in the past? Has there been a way to build your credit score? So that's part of your character. Now, capacity is one that is like your ability to pay. So what that means is, do you have a job? Are you working right now? How long have you been at that job? So one of the lending guidelines is you have to be working for a minimum of 3 months at a job before you're considered permanently employed at a company. So if you're brand new working and you've only been at your job for 2 weeks and you try to get a loan, they will say, no, you can't get a loan right now because you have to be working there for at least 3 months, becoming a permanent employee. If you are self-employed, you actually have to be self-employed for a longer period of time. They usually look at, I believe it's 2 years work history before really taking that into account, looking at your job history for that. So that's a big part of that ability to get a loan. And then capital. Now what capital is like, do you have any assets? Do you have a car in your name? Do you have any savings or investments? You don't need to have a car in your name to be able to get a loan, but what you want to do is maybe have a little bit of savings built up, showing that there's something there that you're building, and they're called assets. You're building something that you own to show that you are working towards something. Okay? And then collateral. So collateral is not something that is needed for all loans, but it can help. So if you are fairly new to Canada and you're starting to just build your credit score, and yes, you've been working at a job for a little while, sometimes depending on the loan, if it's a very large loan, they might ask for collateral, and what that means is they might ask for somebody to be joint or a co-signer on that loan because they're looking to that other person as a safety net, right? So if it's co-signed or joint, those actually mean the exact same thing. So if Jerwin is joint or co-signed on a loan that I got, and I miss payments on that loan, then Jerwin's credit will also be affected.
Oh, I see,
right? And Jerwin would have to be able to qualify for that loan in order to help me get a loan in my name, okay? So we don't always need this, but sometimes the banks will ask you for a co-signer
like
to
a
be
support,
joint.
a little support.
Yeah, somebody else that's taking ownership for that loan if we can't pay it.
Usually in vehicle, right? Sometimes I've experienced that, Someone asking like, oh, if you're gonna buy this one, you need to ask for a co-signer or something.
Yeah. And why they would ask for a co-signer sometimes is maybe you're fairly new at your job or you're just starting to build your credit score in Canada. So that's why they would ask for a co-signer. The other thing for collateral, and you just said a vehicle loan, they might use the vehicle as collateral. So if I take out a loan to get a vehicle, they hold that vehicle as collateral. So if I miss payments on that vehicle loan, they can take that vehicle away from me. And they use that to sell it off and as a safety net for them. Okay. And then the last one is conditions. So that can be market conditions. Like, for example, I'm going to use COVID as an example because this was something that hit all of us all around the world. So if I was a restaurant owner and I was going to the bank to get a loan, right now I'd be probably fine. I've probably had my business for a while and I could get a loan because I'm a restaurant owner. My restaurant's doing very well. But in the middle of COVID, a lot of restaurants were shut down for a period of time. So that's a market condition where that restaurant couldn't be open for a period of time. So the bank could not count on me bringing in money when my restaurant's not working for a moment, right? So market conditions can play a role in being able to get that loan. Like how is it? Basically what you want to think about is banks or lending companies always want to make sure that they are safe. If they give you a loan, they want to make sure that that you're going to pay them back, and that's why those 5 C's of credit come into play.
So what's my next question here is what is TDSR?
Yeah, so TDSR is total debt service ratio. And so this is actually a calculation that has happened, and I'm going to send, German, I'm going to send you a link so you can put that in the video, so where people can find out how to get this information. So there is a debt ratio that we can have, and in order to qualify for a loan, we have to be below a certain amount of that, okay? So in a total debt service ratio, what they would take into account is, for example, if you owned a home, they look at what you're paying for a mortgage, what you pay for property taxes, heat, and if you have condo fees, they take half of that into account, and your debt payments. So if you have a car loan, a line of credit, or other type of debt that you have, they have to take into account those payments. And then they divide that by your gross income. So that's your income that you get take home, or that you get before it's taxed, before your take home income. And so you want your debt ratio to be below 40%. So if we're, for example, trying to buy a house, I want my debt ratio to be below 40%. So what this all really means is that when I get paid, I want less than 40% of my money going towards loan and debt payments and housing costs. I want to have ability to have 60% of my money for food, for getting a haircut, to buy clothes, other things like that. So we want those bills to be below 40%. And if we have like credit cards or loans and our debt ratio is above 40% and we were trying to buy a house, then the bank would say you need to start paying down some of that debt to get that debt ratio down. Okay. Now again, I'll give you a link to look that up. There's a beautiful thing. We have government website that you can look that information up on, and we'll give that to you after. But it's very important that we kind of have a little bit of awareness of that.
So thank you about this one. Actually, we've learned two things from today's vlog. Like we have a lending guidelines, what banks looks at when giving a loan, and then the other one is credit reporting in Canada. So I hope you guys will learn a lot from today's video. And then don't worry, there's another video after this one. Actually, there's a part 2 of this video, which is what is needed to buy a house in Canada. So we'll see each other on the next vlog. Thank you, mga kamamaw.
Thank you.